All right, let's go. So starting off the chapter, another chapter in FM. Let's get a good understanding about this chapter and close this particular reading here. So starting off here, first we look into the objectives of inventory management. And what do we mean by inventory management? Firstly, what do you mean by an inventory investment, right? So inventory represents a major investment for any business, right? So whenever you invest money into buying your stock that you will sell later, that is called as inventory investment. So balanced inventory level, you must not have too much inventory also, too less inventory also. If you have too much inventory also, it's a problem. If you have too less inventory also, it's a problem. If you have too much inventory, where do you store? And if you have too less inventory, customer will go, right? So balancing the inventory is very important. Okay, first is inventory cost, high inventory cost. If you have too much inventory, you need a storage place. You'll have to financing cost and administration cost. If you have too less inventory, then what will happen is then there'll be an insufficient inventory, can lead to stock out and lost sale. If you have too less inventory, what will happen is customer will go, he'll come to your shop, there is no inventory, he will go. That is a low inventory cost. High inventory cost is when excess inventory. If you have too much inventory, what will happen? You'll have to pay for storage. You'll have to pay for financing. You'll have to pay for administration. You'll have to pay a lot of money. Right? If you have too much inventory, you'll have to pay a lot of money. If you have too less inventory, also there is a problem now. Too much also inventory is a problem. Too less inventory is also a problem. Both are a problem. Too much also is a problem. Too less also is a problem. Okay. So that is the point here. And then inventory objective. The objective of inventory is to ensure that to minimize the total inventory cost, right? So let's say the objective of inventory management. What is the objective of inventory management? To ensure that the total inventory cost is minimized. To ensure that the total inventory cost is minimized. The first is what is inventory investment? Yeah, okay, it's again the amount, how much money you have invested in your inventory. That is inventory investment. Second, you have to balance inventory. You should not have too much inventory also, too less inventory also. If you have too much inventory, the high inventory cost is there. That is, you'll have too much inventory, storage cost, financing cost, administration cost. If you have too less inventory, also the problem, customer will go. And the objective of inventory management is to ensure there's a balance, right? To minimize the total inventory cost. Total inventory cost should be minimized. That is the objective of inventory management. Yeah, okay. So this is the first topic, that is what are the objective of inventory management. Ultimately, the objective of inventory management is total inventory related cost is minimized. The total inventory related cost should be minimized. That is the objective of inventory management. Okay. Now, if you have too much inventory, what is the problem? Okay. If you have too much inventory, first of all, storage cost. Yeah. First of all is storage cost. Second is administration cost. First is storage cost. Second is administration cost. First is storage cost, you'll have to store all that inventory. Second is administration cost. Then you'll need someone to manage all that inventory. Then you need security and insurance also, right? So that the rats should not eat off your all your goods. You need a good security, right? You need better storage facilities and you need insurance. If something happens to your inventory, you need an insurance also. For that, you have to pay premium. Then opportunity cost, all the money you have purchased the inventory for, that money, if you had put in somewhere, you could have got some return out of it, right? If your goods don't sell, your money is blocked. If your goods don't sell, your money is blocked then. Okay, that is another problem. If your goods don't sell, your money is blocked. And then you have obsolescence, risk obsolescence, right? Goods may deteriorate or become outdated over time. Goods may deteriorate or become outdated over time, right? Your goods, what will happen to your goods? The goods may deteriorate or they can become outdated over time, right? What happened to your goods is that your goods may deteriorate or become outdated over time. Your goods may deteriorate or become outdated over time. That is the cost of high inventory. If you have high inventory also, there's a problem. Right? If you have too much inventory also, there is a problem. Okay. If you have too much inventory also, there is a problem. Okay. Too much inventory also is a big problem. Okay. Too much inventory also is a big problem. So first of all, the problem is invent opportunity cost. First problem is opportunity cost. Okay. First problem is opportunity cost. Okay. The first problem is opportunity cost. Is that you could have used that money for something else, right? You could have used that money for something else. That's the first problem, opportunity cost. You could have used that money for something else. Okay. What you could have done is you could have used that money for something else. That is the opportunity cost. Second, storage cost. Warehouse and inventory handling. Then you have to store all the goods. If you have inventory, you have to store it also. Second, administration cost. Third is administration cost. In administration cost, you need someone to manage all that inventory, insurance and security. And finally, is obsolescence. If it does not sell, it will get spoiled. If you don't sell the inventory, it will get spoiled. Obsolescence risk. So all these are the cost of high inventory. Now, if you have low inventory, what is the problem? If you don't keep too much inventory, what is the problem? First of all, stockouts. Your customer will go, right? Your sales will go down. Your customer will go. Your customer will go. First is your customer will go. First is your customer will go. Second is you will contribution will be lost. Second is contribution will be lost. First is customer will go. Second is contribution will be lost. Okay. First is customer will go. Second is contribution will be lost. Third is reorder cost, right? Frequently ordering increases the administration and setup cost. Frequently, if you order, it will increase your administration cost, setup cost, ordering cost also will go up. It frequently ordering is also a problem. Okay, next emergency purchase. If you need something urgently, then in urgent basis they will charge a lot. In urgent basis they might charge a lot. Okay, in urgent basis they will charge a lot. Okay, if you need goods urgently, in urgent basis they will charge a lot from you then. Okay, in urgent basis they will charge a lot from you. And finally, loss discount. Small orders may miss valuable bulk purchase discount. If you have small orders may miss valuable bulk purchase discount. Small orders may miss valuable bulk purchase discount. Now, okay, that is loss discounts. Small orders may miss valuable bulk purchase discounts. Okay, so first is stock out. What is stock out? Stock out means you might run out of inventory. You don't have any goods only. Then from where will you get the goods? You will lose sales. Loss contribution is basically a missed sales reduces the profits also, customer satisfaction also. You're losing money. You're losing money, right? What is happening is you're losing money. Missed contribution is reducing the profits and customer satisfaction. You're losing money. Next is reorder cost. Frequently ordering will increase your administration cost also, setup cost also. Right? Frequently reordering will increase your administration cost also, setup cost also. Next, emergency purchase. If last minute you have come to purchase, in the last minute if you go to purchase, then they will charge you higher also. Finally, loss discount. Loss discount. Small orders may miss valuable purchase discounts. If you have small orders, they may miss valuable purchase discounts. Small orders may miss valuable purchase discounts. Right? So if you take a big order, it's great. But if you go for small order, then you might lose a discount. Okay, if you go for big order, it's great. But if you use small order, you might lose the discount. What is emergency purchase? In emergency purchase, urgent orders may often cost more than planned purchase. Urgently, if you order, it will cost you more. Reorder cost, frequently, if you order, then administration cost will go up. Loss contribution, if customers are going, money is going. And finally, stockouts. Running out of inventory will disrupt your operations. If you finish goods are finished now, then how will you sell? How will you make profit? How will you make money? That will be a big problem, right? If you have low inventory, also it's a problem. Yeah. So what does it mean by stockouts here, Sharad? What have you understood, buddy?
Stockouts means running out inventory disrupts operation and sales. Means
Correct. So what happens is your goods are not there. If customer comes to your office, what will you sell him? You have nothing to sell, right? Because you have no goods left. You bought very little, all is sold out. Now customer is coming, what will you do? Nothing, right? Then lost contribution. Lost contribution basically means money is finishing. Reorder cost. Frequent ordering increases the administration. Emergency purchase. Urgent order may cost more often than planned purchase. So urgent order cost may cost more. And loss discount. Small orders, you will miss valuable bulk purchase discount. If you place small orders, when you place big order, they will give you discount. But now if you're playing small orders, you will lose out on that discount. If you're placing small orders, you will lose out on the discount. That is called loss discount. Okay, so now first we have finished the objectives of inventory management. Next, we have written cost of high inventory levels. What is the cost of high inventory level? Cost of low inventory level also we understood if you have too less. Now coming to inventory management. What about inventory management? Firstly, optimum reorder level. Decide when inventory should be reordered. Decide when inventory should be reordered. Firstly, optimum reorder level means at what level of inventory should you place a new order? At what level of inventory should you place a new order with your supplier? At what level of inventory should you place a new order with your supplier? At what level of inventory should you place a new order with your supplier? At what level of inventory should you place a new order with your supplier? Okay, at what level of inventory should you place a new order with your supplier? That is called optimum reorder level. That is called optimum reorder level. Next, optimum reorder quantity. Okay, next time when you order, how much you should order? Next time when you order, how much should you order? Next time when you order, how much should you order? Okay. Next, holding versus stock out cost. Balance the inventory carrying cost with shortage cost. What you should do is balance out your inventory carrying cost with your shortage cost. Balance your inventory carrying cost with shortage cost. Next, liquidity versus profitability. Efficient inventory management improves both liquidity also and profits also. If you manage your inventory well, your liquidity also will improve and your profitability will also improve. If you manage your inventory well, your liquidity will also improve, your profitability will also improve. Next, cost optimization. Aim to minimize the total cost. Your main aim is to minimize the total cost. In inventory management, the main aim of inventory management is to minimize the total cost. Main aim of inventory management is to minimize the total cost. Main aim of inventory management is to minimize the total cost. Liquidity versus profitability. Efficient inventory management will improve both your liquidity also, profitability also. Holding versus stockouts. Balance your inventory carrying cost with shortage cost. Balance your inventory carrying cost with shortage cost. Next, optimum order quantity. Okay, optimum order quantity. How much inventory should you order each time when you place an order? How much? Second, when you should place an order. Next is when you should place an order. What is inventory management? First is when you should place. Second, if you place, how much you should place. Then holding versus stock out. Balance your inventory carrying cost with shortage cost. You have to keep a good balance. And then liquidity versus profitability. If you balance your inventory well, your liquidity will also be good, your profitability will also be good. And next is cost optimization. Aim to minimize the total cost of inventory management. Your aim should always be to minimize the total cost of inventory management. Okay, some important terminologies are there. Let's understand the terminology. First of all, lead time. Lead time basically means when you place the order, when you receive the good. The time gap in between is called lead time. When you place the order, when you receive the good, the time gap in between is called as lead time. When you place the order, when you receive the good, the time in between is called as lead time. When you place the order, when you receive the good, the time in between is called lead time. When you place the order, when you receive the good. Buffer inventory is extra stock. Buffer inventory is extra stock. Whatever you need, you keep little extra. How much ever you need, you keep a little extra. That is called buffer inventory. How much ever you need, you keep a little extra. That is buffer inventory. Reorder level. Inventory level that triggers a new order. The inventory level that triggers a new order. That is called reorder level. The inventory level that triggers a new order. The inventory level that triggers a new order is called reorder level. Inventory level that triggers a new order is called reorder level. Inventory level that triggers a new order is called reorder level. Next, reorder quantity. The number of units ordered each time. Reorder quantity. Number of units ordered each time. What is reorder quantity? Number of units ordered each time. Okay, what is reorder quantity? Number of units ordered each time. Okay, number of units ordered each time is called reorder quantity. Okay, number of units ordered each time is called reorder quantity. Number of units ordered each time is called reorder quantity. Key concepts. Understanding terminology will support effective inventory control. Understanding terminologies will help you in the inventory control. Okay, firstly, we understood what is lead time. Time between placing an order and receiving an order. What is lead time? Time between placing an order and receiving an order. That is called lead time. Next, buffer inventory. Extra inventory held to manage uncertainty. The extra inventory that you have held to manage the uncertainty. Reorder level. Inventory that triggers a new order. Reorder level. At what level will you place a new order? How much should be there in your inventory that you will place a new order? Reorder level. Reorder quantity. That every time that you order, how much will you order? Every time that you order, how much will you order? Reorder quantity. So it's important to know these terminologies. Now coming to EOQ. What do you mean by EOQ? EOQ basically means that the most economical order quantity. That every time you order, you should order this much. Every time you order, you should order this much. That is called EOQ. That how much should you order such that your holding cost is minimal, your ordering cost is minimal. EOQ means how much should you order such that your holding cost and ordering cost is minimal. That is called EOQ, economic order quantity. How much should you order such that your ordering cost is minimal and your holding cost is minimal? How much should you order such that your ordering cost is minimal and your holding cost is minimal? Okay, how much should you order such that your ordering cost is minimal and your holding cost is minimal? Okay, how much should you order such that your ordering cost is minimal and your holding cost is minimal? Okay, how much should you order such that your ordering cost is minimal and your holding cost is minimal? Okay, how much should you order such that your ordering cost is minimal and your holding cost is minimal? Okay, how much should you order each time? Okay, how much should you order such that your ordering cost is minimal and your holding cost is minimal? Okay, your ordering cost and your holding cost is minimal. How much you should order each time? That is called EOQ, economic order quantity. Your holding and your ordering cost is minimal. How much you should order such that your holding cost and ordering cost is minimal. Then minimum total cost. If you balance your EOQ, you will see EOQ basically what it does is it balances your ordering cost and holding cost. What EOQ does is that it balances your ordering cost and holding cost. What is holding cost? It's basically the storage cost. What is ordering cost? Every time you order, you have to pay some cost for ordering also. That is called ordering cost. And if you have a optimal balance, and that is what EOQ does. EOQ is that level of that order quantity that you should order each time such that your holding cost and your ordering cost is minimized. EOQ is that order quantity that you should order each time such that your holding cost and ordering cost both will be minimized. What is EOQ? EOQ is that quantity that you should order each time such that your holding cost and your ordering cost both is minimized. Okay, that is about EOQ. Okay, now coming to the formula. How do you calculate the holding cost? How do you calculate the ordering cost? Okay, so let's look into this. How do you calculate both? So first for the formula, I will just stick it here so that whenever you learn to calculate, it becomes easy. So this is how you calculate your ordering cost. So this is how you calculate your ordering cost. Okay, I'm just sticking the formula right here. How do you calculate your ordering cost? Holding cost is an ordering cost. So ordering cost here is the formula. Then holding cost, this is your formula. This is how you calculate the holding cost. Holding cost formula. And then you have ordering cost formula. Both the formulas are here. Holding cost also formula I have stuck. Ordering cost also formula I have stuck. Holding cost and ordering cost. Okay. And then EOQ also formula I will just stick. What is the formula for EOQ also? What is the formula for EOQ? Only next to definition only I will stick EOQ. Okay, so three formulas are right here. What is the formula for EOQ? What EOQ does? It minimizes your total cost. Okay, what EOQ does? It minimizes your total cost. What EOQ does is that it minimizes your total cost. Okay, what EOQ does? It minimizes your total cost. Clear, buddy? No? Okay, holding cost. Holding cost formula is there. Ordering cost formula is there. Okay. Holding cost is there, ordering cost. EOQ definition, economic order quantity, that formula is over here. How to calculate EOQ? That definition is a formula is there, holding cost formula is there, ordering cost formula is there. So all the formulas written over here, here is how to calculate also. Okay. Total cost done. EOQ assumptions. There are some assumptions of EOQ. First is demand is always constant. Assumptions of EOQ, demand is constant. Assumptions of EOQ, demand is constant. What are the assumptions of EOQ? Demand is constant. Okay, assumptions of EOQ, demand is constant. Second, constant lead time. Delivery time is known and consistent. Your delivery time is known and it is consistent. Your delivery time is known and it is consistent. Next, constant purchase price. The purchase price does not change. Next is purchase price will not change. Next is purchase price will not change. Next, no buffer inventory. Basic EOQ assumes no safety stock is held. No safety stock is held. Right? There is no buffer inventory. No safety stock is held. No buffer inventory. No safety stock is held. And EOQ formula is right here. We have stuck on top also. Here also there is the formula. Should I stick it right again? This is the formula of EOQ as well. This is the formula of EOQ. Same formula is written. Same formula is here. Okay, this is your formula of EOQ as well. Okay, then we have some sums on EOQ. Let's look into this. Okay, so this has given us an idea about EOQ. Now we'll look into some sums and get a good understanding about EOQ. Okay, so let's do first sum here. Okay. Can you see it, buddy?
Yes.
Yeah. Okay. Okay. Now what is happening over here is that firstly, what they have told us to find. First, we'll see what they have told us to find. In this curve, what we have to find out, what is the cheapest option. Okay, and here what we have to do is calculate the EOQ. Okay, so first we should know what we have to find. First, we know what we have to find. Second, we look into the formula. See, can you see the formula here? This is the formula. Okay, so we have to find all the elements. So let's highlight one. First, we need CO. Okay, if you see here in this formula, 2 will be as it is. First, we need CO. What is the ordering cost? We found the CO. Okay, I'll just change the color for CO. We found the CO. Ordering cost. Okay, here the ordering cost is $30. In second case, what is the ordering cost? $200. Yeah, have you found the ordering cost in both the cases? First case ordering cost is $30. Second case ordering cost is $200. The CO is done. Next, we have to find the demand, annual demand, yearly demand. Next, we'll find annual demand, 1,000 per month. Yeah, here monthly demand is 10,000 per month. Monthly demand is 10,000. So if 1 month 10,000, 12 months will be how much, buddy? See,
12,000.
yeah, 1,20,000. Okay, 1 month is 10,000. 1 month is 10,000. 12 months is 1,20,000. Okay, and if 1 month is 1,000, 12 months is 12,000. Yeah, if 1 month is 1,000, 12 months is 12,000. So we have found the demand also. So you see, CO is also done. First question, what is the CO, buddy?
30.
30. Second question, what is the CO?
7.
Can you see?
Purchasing.
See here, 200. Yeah. Yeah. Okay, it's hard. Yeah, so it is 200. Okay. Second case, it is 200. First year, monthly demand is 12,000. Second, annual demand is 12,000. Monthly 1,000. 1 year, 12,000. Here, monthly demand 10,000. 1 year, 1,20,000. So we have found CO, we have found D. CH. Now we need CH.
2.8.
Perfect. In the first case, 2.28 per unit. Per unit, per year, 2.288. This is your holding cost. Here, what is the holding cost? Holding storage cost will be 2 per unit. Okay, so you see, you have found CO, you have found D, and you have found CH. Yeah, all the three are characters you have found out. All the three characters you have found out. You have found CO also, D also, CH also. All three characters you have found out. Okay, you have found all three characters. CO also, D also, CH also. Okay, CO also, D also, CH also. All three characters you have found out. Okay, CO also, D also, CH also. Okay, you have found all three characters. CO, CH and D. Okay, CO, CH and D. Okay, CO, CH and D. Okay, this is CO, CH and D. CO, CH and D. Okay, CO, CH and D. All the things we have understood what is CO, what is CH, and what is D. CO, CH, and D. All we have found out. CO, CH, D. CO, CH, and D. CO, CH, and D. Okay, CO, CH, and D. We have found out all of them. CO, CH, and D. Okay, CO, CH, and D. Okay, so this is all about the two questions. Now we will try to put it in the formula. Okay, now we'll put it in the formula. Okay, now we'll put it in the formula. The first is D. Okay, D is 1000. What is D? D is 1000 units. What is D? D is 1000 units. What is CO? D is 1000 per unit. What is D? D is 1000 for 1 month. 12 months, 12,000. Yeah, D is 12,000. So D we have figured out 12,000. CO we already know 30. CH we already know 2.88. Okay, 2 will stay as it is. We will put a square root of this. We will get 500 per unit. That is our answer. We will get 500 per unit. That is our answer. Yeah, 2 into CO into D divided by CH. 2 into CO into D divided by CH. Okay, 2 into CO into D divided by CH. That is our economic order quantity. 2 into CO into D divided by CH. Okay, divided by CH. Okay, divided by CH. That is our economic order quantity. Okay, so this is how we will calculate, and we will get economic order quantity. Okay, this is how we will calculate, and we will get economic order quantity. This is how we will get economic order quantity. Okay, so this is how we are getting economic order quantity. Okay, this is economic order quantity. Done. Okay, let's apply it in the next sum here. And let's get a good understanding in the next sum. Let's look at it in the next sum here. Okay, in the next sum, same things, let's apply and see if we can get an answer. If you see in the next sum here, same. First we needed 2. 2 will be as it is, no problem with 2. Then we need CO. CO we have identified 200. CO is also done. Next we need demand. Demand is 10,000 1 month. 1 year, 1,20,000 as it is. Next they are telling here the CH. CH we have found 2%. Okay, they have said 2%. Right? The purchase price is 10 per unit. So they have taken as 2 per unit, right? But here if you see how much we have taken 3 per unit. Why? Because what happens over here in case of CH, the warehouse storage cost per unit are $2 per unit, and the company's cost of finance is 15%, right? Cost of finance. So company's cost of the purchase price is 10. So see, if the purchase price is $10, on this cost of finance is 15%. So for $10, 15% you have to take plus $2. This will be your holding cost. The holding cost includes the opportunity cost of holding inventory. Very important. So see, here was a basic sum. EOQ1 was a basic sum, straightforward. In this sum, one new thing we have learned. What is the one new thing? Every sum will teach you one new thing. What is this one new thing? That in the holding cost, you should also add or in the holding cost, you should also add financing cost. In the holding cost, what you should add, see, in this sum, everything was given as it is. But see, so easy sum they will not give. So every sum they will just give one small extra thing to learn. So in this sum, what they have told, that you have to just take the 15% of the $10. You have to include the opportunity cost of holding inventory. You have to include the opportunity cost of holding inventory. You should use the opportunity cost of holding inventory. So for $10, 15% is the opportunity cost. So 0.15 is the opportunity cost plus $2. 0.15 is the opportunity cost plus $2. 3.5 is the total opportunity cost. 3.5 is the total opportunity cost. How much is the opportunity cost? Holding cost is total 3.5. That's it. Holding cost is 3.5, and that's why you got the 3.5. Okay, the only difference between these two sums is that here they have given a two-step formula to find out the holding cost. If you see holding cost, you have to take 10% of the 15% of the purchase price and then add it to the two. Right? Why? Because the holding cost will increase the opportunity cost. So here holding cost is one step extra calculation, little extra calculation in the holding cost. Okay, little extra calculation in the holding cost. Okay, what is here is a little extra calculation in the holding cost. What is here is a little extra calculation in the holding cost. What is here is a little extra calculation from the holding cost. Okay, a little extra calculation from the holding cost. Okay, a little extra calculation from the holding cost. That's it. Okay. So here if you see it was straightforward 2.88. In this sum, what you have to do, you have to take the two. Now the purchase price 15% you have to take because the holding cost will also include the cost of holding inventory. Okay, I'll write it in the notes also. I'll update it there so it's easy later on. Okay, in your holding cost, you have to also include cost of your holding cost. You have to also include cost of holding, opportunity cost of holding inventory. You have to also include the opportunity cost. Also include the opportunity cost. Okay, two sums done. Now we'll look into the third sum here, dealing with discounts. So they'll give some discounts. So the best way to do is to how to deal with discounts. So let's look into dealing with discounts. Okay, so dealing with discount, there's an easier method of doing it. We will look into that, how you can deal with discounts. Okay, so there's a calculation of dealing with discounts. Let's look into that. Okay, so before we get into the calculation of dealing with discounts, let's look into the remaining part of the chapters first, and then we'll go about this. Dealing with discounts, we'll look at in the last year. Okay, now we'll look into some basic topics of reorder level and inventory management system. First, let's look into the reorder level. What about the reorder level? Okay, what do we understand by reorder level? Okay, so we have studied over here. What is reorder level? We have looked into holding cost. Okay, so if we look into firstly what is, wait, where were we last? Reorder level is done. Next, we look into inventory management. So first is lead time. We have done this. Key concepts. EOQ definition we have looked into. Okay. EOQ holding cost we have looked into. We have stuck the formula also. EOQ assumptions we have looked into. With discounts we will do towards the end. Now we'll calculate the reorder level. Let's study calculating reorder level. What is reorder level? And how much should be in your go down before you place a new order with your supplier? Okay. How much should be in your go down before you place a new order with the supplier? How much should be in the go down before you place a new order with the supplier? Okay. That is called reorder level. That how much should be in your go down when you place a new order. Okay. And how do you find it? Reorder level equals the demand during lead time when certainty exists. So how do you calculate the reorder level? That you take the demand during the lead time, right? You take the demand and multiply it with the lead time, right? How much demand is needed in the lead time? When that much goods have been received, then that much level of inventory has been arrived, then you have to place a new order, right? So what is your reorder level? It's the demand during lead time. What is reorder level? Demand during lead time. What is variable demand? Buffer inventory is needed when demand is certain. So whenever demand is uncertain, you need buffer inventory. When demand is uncertain, you need what? Buffer inventory. What is buffer inventory? Extra inventory. What is variable lead time? The extra inventory protects against delivery delay. Sometimes what happens is delivery, the supplier will delay. So if you have some little extra, it will help. Sometimes supplier will give late. So if you have little extra, it is very good, right? Sometimes the supplier will delay. So if you have little extra, it's very good. Next is inventory control. What is inventory control? Correct reorder level will help prevent stock shortage while avoiding excess inventory. Okay, reorder level, what it will do is it will help prevent stock shortages while avoiding excess inventory. What will reorder level do? It will prevent your stock shortage, right? If your reorder level is correct, then you will see you'll never have shortage. You'll never have extra also, you'll never have shortage also. Okay, if you have a correct reorder level, you will never have extra, you will never have shortage. That's the best thing about reorder level. Never extra, never shortage. Okay. Next, we'll look into inventory management system. So there are mainly two types of inventory management. So see, managing inventory is very important. If you have too much also problem, too less also problem. So management is important. So first of all, first method is periodic review. At every fixed interval of time, you will review the inventory. After every fixed interval of time, you will review the inventory. After every fixed interval of time, you will review the inventory. Okay, after every fixed interval of time, you will review the inventory. That is called periodic review. After every fixed interval of time, you will review the inventory. Okay, just in time inventory, that you will not keep any inventory. Whenever you want, you will just order. You will not keep any storage of inventory. Whenever you want, you will order immediately, you will get it because you would have set a, such a system that whenever you want, you will order, right? Like Ola and Uber, whenever you want, you will just order or book it, you will get it. Okay, so just in time, minimize the inventory by receiving materials only when you need, you will order. That's it. Okay, when you need, you will order it. That's all. Inventory optimization. Both systems aim to balance inventory within the inventory availability with cost control. Inventory optimization. Both systems aim to balance inventory availability with cost control. Inventory optimization means both the system, periodic review also, just in time also. What they will focus on is balance the inventory availability with cost control. What it will do is balance the inventory availability with cost control. And finally, working capital. Efficient working capital improves the cash flow and reduces the holding cost. Effective inventory management improves the cash flow and reduces the holding cost. Effective inventory management improves the cash flow and reduces the holding cost. Effective inventory management improves the cash flow and reduces the holding cost. Effective inventory management, what it will do is it will improve the cash flow also, it will reduce your holding cost also. That is the biggest benefit. Now we'll look into the two methods here. First one, periodic review. So what you do is inventory are checked at regular intervals. Every 4 weeks you will count inventory. Example, every 4 weeks you will count inventory. Target stock level. Orders restore inventory to a predetermined level. So what you do, you have a target stock level. So orders will restore the inventory to a predetermined level. Demand forecasting. Stock levels consider demand before the next review and during lead time. So basically what happens is you will do forecasting that how much goods you will need, how much goods you will need in the future. You will do a forecasting how much goods you need in the future. You will do a forecasting. Next, lead time. What is lead time? When the time between you placing the order and you receiving the goods. That is called lead time. If your lead time is very long, then you will need higher inventory. If your lead time is long, you will need higher inventory. If your lead time is long, you will need higher inventory. If your lead time is long, you will need higher inventory. Next is supplier benefits. Okay, next is supplier benefits. What do you mean by supplier benefits? Regular ordering schedules provides a predictable demand for suppliers. If regular ordering schedule, if you order regularly, okay, if you order regularly, regular demand, yeah, regular reviews identifies, sorry. So we got the supplier benefits here. So we got the lead time supplier. So regular ordering schedules provides predictable demand for suppliers. If you order regularly, supplier is also very happy, right? Because he's also getting a predictable demand for suppliers. So regular ordering schedules provides a predictable demand for suppliers. Regular ordering schedules, it provides a very predictable demand for suppliers. That's the biggest benefit for suppliers. Okay. Then we have two types of inventory here. So let's look into the first one. We have two types of inventory. Let's look into the first one. Okay. So we look into the first one here. Slow moving inventory. So now let's look into slow moving inventory. Let's look into slow moving inventory. What about slow moving inventory? Okay. So let's look into slow moving inventory. So what do you mean by slow moving inventory? Slow moving inventory is some inventory values have low demand but high individual value. Demand is not much, but the value is very high. So about 20% of the items account for 80% of inventory usage. Okay. So 20-80 rule is 20% of the items is 80%. Okay. Then we have aged inventory analysis. Okay. So regular reviews identify obsolete and slow moving items. Item no one is buying only. It is just kept and kept and kept and kept and kept. No one is buying that. Right. Obsolete and slow moving items. Next, inventory reduction. Yeah, inventory reduction. Obsolete inventory should be disposed of or purchased only when required. Obsolete inventory should be disposed of or purchased only when required. Okay, obsolete inventory should be disposed of or it should be purchased only when required. That obsolete inventory, you should either dispose it or should be purchased only when required. Obsolete inventory should be disposed of or purchased only when required. Finally, we have demand review. Reorder level should be updated based on changing demand patterns. Reorder level should be updated based on changing demand patterns. What is reorder level? Reorder level should be updated based on changing demand patterns. If demand is changing, reorder levels will also change. Finally, we have just-in-time system. What happens in just-in-time system? So see, whenever you need the goods, you will just get it. You don't store anything or minimal storage, minimal inventory at the lowest possible level, a limit or post lowest possible level. You'll keep the inventory at the lowest possible level, right? Just in time produces goods only when customers require them. Just in time will produce the goods only when customers require them. First is minimal inventory. Inventory is reduced to the lowest possible. Inventory is reduced to the lowest possible level. Customer focus. Production responds directly to customer demand. Production responds directly to customer demand. Efficient production. Just in time improves your workflow and reduces unnecessary delays. Just in time improves your workflows and reduces any unnecessary delay. Just in time improves your workflow and reduces any unnecessary delays. Next, capital reduction. Lower inventory frees up working capital for other uses. Lower inventory frees up working capital for other uses. Lower inventory, what lower inventory does? It frees up the working capital for other uses. Lower inventory, it frees up your working capital for other uses. Lower inventory frees up working capital for other uses. Okay. Next we have just in time and waste elimination. So just in time, the biggest benefit, it removes activities that do not add value, totally removes it. Excess raw materials are minimized. Work in progress, smaller production batches reduce. You make in small batches. You never make in large batches now. You make in small batches. And when you have small batches and not excess raw material, the quality will be better, defects will reduce. Quality will be better, defects will reduce. Okay, your quality will be better and your defects will reduce. Okay, that is called quality improvement. Your quality will be better and your defects will reduce. Your quality will be better and your defects will reduce. Work in progress, smaller production batches reduces the work in progress. And finally, material handling. Factory layout minimize unnecessary movement. You lay out your factory in such a way that unnecessary movements are minimized. You lay out your factory in such a way unnecessary movements are minimized. You lay out your factory in such a way unnecessary movements are minimized. Okay, that is about this. Finally, benefits of JIT. Just in time, what are the benefits? First one, smooth workflow, because there will be very less inefficient steps. The inefficient steps will be very less. So product move continuously through production without any delays. Flexible manufacturing. Production will quickly adapt to customer requirements. Flexible manufacturing. Your production will quickly adapt to customer requirements. Next, low inventory investment. You have very less money tied up in inventory. You have very less money tied up in inventory. Faster delivery. You will reduce the lead time and you will improve customer service. You will reduce the lead time and improve customer service. You will reduce the lead time and improve customer service. And finally, improve productivity. Improve productivity. Efficient processes increase operational performance. Efficient processes will increase your operational performance. Processes will increase your operational performance. If you have no wastage, a very efficient process, you will see your performance overall will be very good, right? And how should be your relationship with your supplier? Businesses often rely only on one supplier. In this case, long-term contracts with one supplier will strengthen the relationship. Reliable frequently deliveries support the continuous production. And finally, local suppliers, the nearby the better. Reducing transportation risk, mutual benefits. Suppliers receive predictable business while manufacturer reduce the inventory cost. It's best for both. And finally, just in time logistics and cost impact. Frequent deliveries. Smaller deliveries are made more often. Transportation partnership. Logistic providers become key business partner. The person has become like your business partner only, right? Because he's going to provide you goods whenever you need it. Holding cost. Inventory holding cost is reduced. Ordering cost has gone up because now you're increasing a lot, ordering a lot more. Overall, your business becomes very operationally efficient despite the higher operating frequency of ordering cost and ordering very frequently. When you compare the two systems here, periodic is at fixed intervals, just in time is whenever you need it. When you see holding cost, just in time is minimized, but you see ordering cost, just in time is very high. Ordering cost, just in time is very high. Okay, in case of ordering cost, just in time is very high. Okay, in case of ordering cost, just in time is very high. Okay, in case of ordering cost, you will see, yeah, in case of just in time, you will see the ordering cost is very high. Okay, next, business suitability. The choice depends upon production needs and supplier reliability. The choice depends upon production needs and supplier reliability. The choice that which one will you go? Will you go for periodic or will you go for just in time? That depends upon production need and supplier reliability. Okay, and this is just like a summary of everything that you can just go through of inventory control. Okay, so this is the entire reading.